Welcome to the webinar of the European Resource Bank that will discuss the proposal for a global corporate or a global minimum corporate tax rate. This was decided at the G7 summit. My name is Pieter Cleppe. I'm the editor-in-chief of BrusselsReport.eu, and I will be the moderator. And we actually have quite a nice panel. We have Andreas Hellmann from Americans from Tax Reform Foundation. We have Barbara Kolm, the director of the Austrian Hayek Institute and the vice president of the Austrian Central Bank. And then hopefully also, if he has arrived, we will have Henrik Schneider, the chief economist of the Swiss Medium and Small Enterprise Federation. So to start, maybe I should introduce the topic a bit. So Janet Yellen, the American Treasury Secretary, has been pushing for this minimum global corporate tax rate, and some kind of a deal was agreed at the G7 first, and after that at the G20. Now, several European countries are not overly happy with that, and also Russia and China are also not likely to play along seamlessly. But in order to explain all that, I'm happy to give the word to the first speaker, and that's Andreas Hellmann of Americans for Tax Reform Foundation. Andreas?
Thank you, Peter. Thank you, Barbara, for organizing this event. And I would like to start to give a little bit of an overview about the topic and the background, how we actually ended up being in this position. And so it is important to know that the global minimum tax was always part of the Pillar 2 proposal of the OECD. There's two pillars, Pillar 1 and Pillar 2. And the reason why this process was started in the first place was because the OECD was asked to put up a proposal to end those unilateral measures of digital services taxes and other discriminatory taxes against American tech companies, and to find a solution for new ways to tax more fairly in the digital world. And during the Trump administration, his administration basically said, we're willing to talk, we're willing to negotiate, but everything that is still discriminatory and puts American companies at disadvantage, we will not join. And so he came up with the safe harbor proposal. And that basically means that they will negotiate and they might agree on something, but it will be up to American companies to be able to opt in or opt out. So depending on if it makes sense for them to join and accept the new rules, they can do that. Otherwise, there will always be a safe harbor provision that will put them in a position where they can say no if things do not work out for them. And so I think that is a very interesting approach, because it keeps American interests at hand, and also is important to see that we're coming from a position where American multinationals were discriminated against and basically looted by the European Union and other countries, like France especially, who came up with the first DSD, but also Austria and Poland and Czech Republic and Spain and many others. And so now we're in a position where President Biden sees that the Pillar 2 is much more interesting for him than the Pillar 1. And why is that? Initially, the OECD proposed a 4% global minimum tax, basically just to get a foot in the door, to have some number to start with. And that was heavily pushed by the European Union. The European Union always tried to harmonize tax rates within the union, and they were never successful. There were always member states like Ireland and Luxembourg and others that heavily fought against those efforts. And so the European Union saw this OECD proposal as a way to, push their tax harmonization efforts on a different level, and then maybe through the backdoor deal can implement it on the European level. But it was never a real part of the solution to ending DSDs and unilateral measures. That was Pillar 1. So Biden comes into office, and he interestingly decides that he will raise taxes quite significantly. And if we If we look at the numbers, he proposed 30 tax increases on American families and businesses, over $3 trillion over the next 10 years. He proposed to raise the corporate tax rate from 21%, that is the lower rate from the Tax Cuts and Jobs Act under Trump, back to 28%. And so if you factor in state corporate taxes in the U.S., that rate will be at an average of 32%, which will be significantly higher than in China. They have 25%, and it will also be higher than the average European rate, which is at 23%. And so he thinks now that, the US is obviously with the higher tax rate at a disadvantage. And so he needs to protect the competitiveness of the United States. And for him to do so, he figures that the global minimum tax would be a good solution, because it would create kind of this cartel of governments to set a minimum rate. And so companies and people couldn't vote with their feet anymore and just move someplace else, because there's a minimum floor of taxation. And as in every other market decision, that is a bad idea. If you put a floor on the cost of a product, it will be bad for the consumer. In this case, it will be bad for companies and workers, and also just average citizens, because prices will go up. And it will also end tax competition, which is very, very vital between nations to attract businesses and workers and IP and other things that factor in for their economies. And so that's where we're coming from. We definitely disagree with the proposal of Biden and the G7 agreement that has been signed. So we put out a coalition letter of 76 conservative groups from 40 different countries that we sent to Congress in order to urge them to oppose this agreement, which has to pass both chambers of Congress. And so the last point I would like to make, because I feel like that is very, very important and people tend to forget about this. And Peter mentioned it, actually, there's countries like China and Russia, and they don't have our best interests at heart, and they're competing heavily with American tech companies and European pharmaceutical companies on many different levels. And for them to see this huge opportunity that the Western world is restricting themselves and locking in tax rates, for them it's a huge opportunity, because they already plan to lower their tax rates. They will create more incentives for companies to move there. They already have massive subsidies in place for their own industries that they want to push. And so we create this artificial imbalance where we give our most fierce competitor in the world a better shot at winning this race at a time when it's so critically important that our technology and our infrastructure prevails over China's. And so I feel like this might be a very, very short, thought after solution from Biden to protect American competitiveness artificially for the next, I would say, 4 to 5, 6 years. But in the long run, it would do significant damage, not only to the US, but also to Europe and to our way we tax. And so we should be very, very careful of implementing this proposal. My opinion is we should fight Pillar 1 and Pillar 2 of those proposals. They both don't really do a lot of good things. With Pillar 1, we would also get rid of the physical presence standard, which might sound good for the European Union in the very, very near future. But if we change the fundamentals of how we tax companies in the world, this would also put European companies at a disadvantage if countries like China or Russia decide we will switch over from the physical presence standard to a user-based tax. Just imagine that China would come up with the idea of taxing, not only taxing German cars as imports, but they would also tax every mile driven by a user in those cars, because the principle of value creation and physical presence would be turned around, and you would change things to a user-based tax. So I would like to share the link to our coalition letter if you would like to read it in the chat, and I'm looking forward to questions later on. Thank you.
Thank you very much, Andreas. I should also mention that Andreas Hellmann has published an article on brusselsreport.eu on this precise topic, so you can also read more there, and maybe Andreas can also post that in the chat for those that are interested. That said, I'm more than happy now to announce the second speaker, Miss Barbara Kolm. Barbara is the director, as said, of the Austrian Hayek Institute. She's also the vice president of the Austrian Central Bank. And even more importantly, for years, she's now been running the European Resource Bank and the Free Market Roadshow, which is an excellent initiative. She's been fighting for individual freedom for a long time. So welcome, Barbara, and please, I give you the words.
Well, thank you very much, Peter, and thank you very much, Andreas, for introducing us and for presenting actually the coalition letter, which is very important that we remind ourselves that tax competition eventually has brought wealth to our European nations. And let me start with one nation, and you already mentioned it, Ireland. 30 years ago, Ireland had been the sick man of Europe. It was, or actually more than 30 years ago. It was the poorest country in the European Union, in Europe, and it was definitely the sick man. What happened? The government back then embraced tax competition, or understood that if they reduce their corporate taxes, if they reduce income tax rates, if they provide a healthy environment for enterprises, allowing them to invest and to prosper and create jobs there, then all of a sudden you create wealth also for the individuals living in the country. The per capita income has risen, has not only quadrupled, but much more in the past years, ever since Ireland has joined the European Union. And eventually, right now, they have a corporate tax rate of 12.5%. And if they are forced to rise it, they definitely will lose a lot of revenue streams, also from those corporates based in Ireland. This is one side. The other side is that, having said that, in order to be just and fair, which is, just taxation, which is the one size fits all taxation, those countries who have understood that competition also on the tax sector is important will be punished. And by that, Ireland will be will not be as favorable for investment, for foreign investment, and for companies, and therefore they will lose jobs. They will create, in other words, a group of people that will be unemployed because companies will not come and open enterprises and businesses there. So what would be the benefit for just for this country? Less revenue streams on the one side, and on the other side, you reduce the wealth rate of the individuals, and you have more unemployment. Definitely not good for a society like that. This is one argument. The other argument is, well, we are in the European Union. We actually should try to create the one size fits all. Everybody has to pay the same fair share of taxes. And therefore, we all try to eliminate competition among each other and also among other nations. But, I think this is a very short-sighted argument, because if we look at Europe, and if we understand that competition has always created wealth and has created innovation, we've always been better off. And if countries, especially small countries, all of a sudden, even if they have higher taxes and reduce the tax rate, the corporate tax rate to 15%, think it is positive, they probably have forgotten that they are export countries. And here we should look at the numbers. And the German Steuerzahlerbund, the tax groups in Germany, they have actually calculated the numbers for Germany. And you can use those same numbers divided by 10, more or less, for Austria. And they claim that the adoption of this mandate of that the G7 wants to impose on all the countries is totally negative, and they would create losers, because the adaptation of the common tax base is negative for the enterprises in Germany, because those countries are export countries. It's an export country, and therefore it would lose a lot of revenue streams. So this tax is also negative, consequently, for corporations in countries that have higher tax rates, and Germany definitely has a very high corporate tax rate. So you have both arguments, both sides, and it definitely doesn't help. Apart from that, under the disguise of Corona, which is the best excuse for all regulations and all new laws, this tax initiative is definitely not a good thing. We have too many problems worldwide that we should focus on. We lack innovation. If we look at the European regions and how they are based on the European innovation scoreboard, then we should definitely do our homework on that front, and not create new regulation and new disadvantages for our business location. But it's also something apart from the numbers and the figures that are at place, and Andreas has already mentioned them. And if we look into the numbers that also Peter and others have published, also our friends from Sweden, then we should also look at the psychological side and the moral side, because you create a jealousy, which is artificially done, because you have the countries that are just and those who are not, because those who do not agree to the proposal are not, they are unjust and they are not fair. This doesn't have anything to do with fairness, and the top-down one-size-fits-all plans have never helped create jobs and have never helped create wealth. As a matter of fact, if we collaborate and compete with each other, then we have always been more successful in terms of wealth creation and income for our individuals. And there are less people who live on a $1 base these days than 10 years ago. And that's what competition is about, to allow to maneuver yourselves out of the swamp. And this proposal actually fails the basic of the rule of tax policy, that levies should be easy to understand, eventually applied, and hard to avoid. I mean, the tax percent threshold represents an open goal for the kind of savvy accountants employed by big firms who are more than capable of shuffling a few columns about to minimize their client's tax bill. And that's also something that we should consider. Why are we writing or supporting this proposal, or why should we not support this proposal? Who is the who is the benefactor of that? Who receives the benefits? And it's definitely not the governments of our Western world, because they will eventually lose revenues and income. And therefore, I would leave it like for now, but there's plenty of other arguments that we could put into the discussion, and I'm open to any discussion.
Thank you very much, Barbara. I'm not sure if Henrique has arrived or not.
I just heard that he's still with the minister.
Oh, okay.
And in a meeting, and he will join as soon as he's done.
That's fine. That's fine.
If you allow, I would make 2 additional points based on what Barbara said.
Please, Andreas, go ahead.
So I think it's very interesting that Barbara mentioned Ireland, and just to give you 2 numbers that show how important tax competition is for their economy. 40% of their employment is in American multinational companies that are based in Ireland now. And 60% of their entire corporate tax revenue comes from American multinationals. So it shows how dependent their economy and their success is based on attracting foreign businesses and foreign investment. And you can see that the approach that the European Union is trying to push forward to harmonize all taxes between member states is something that is not good. Even in the US, we have tax competition between member states. We have various different state taxes. We have states that have no state income taxes. We have states that have no state real estate taxes or sales taxes. And that all corresponds with a different cost of living in those states, different opportunities there. And so it's sometimes more attractive for people to leave their state and move to a state, where there's no state income tax, or there's other things that fit their lives better. And so there's competition between those states. And you can see it actually happening right now. A lot of people are leaving states like New York or California and moving to states like Texas, and other states, because their work environment has changed. They've probably figured, I can work from home, I can work from anywhere. So why would I live in a state with very, very high levels of taxation? And so it's healthy to have this competition, because it always shows that the states with the higher taxes, they have to be either much, much better and offer better infrastructure or have other incentives for people to stay, but they have to compete. And so there's always progress in that process, which I think is very, very important. One last point I would like to make, and I feel like that is very, very interesting, especially the European Union. They have tried so many American companies based on so-called antitrust investigations and trials. And they imposed fines on them for forming cartels and not competing fairly. And competition is apparently so important for the consumers, especially in the European Union, so they have better choices and lower prices. And so all of that is based on the fact that the European Union says competition is good and important and vital, and we have to enforce it. But then the moment the governments form a cartel to impose the global minimum tax, then competition is bad and it shouldn't exist. And we should only have one size fits all approach in terms of taxation. And that shows you the double standard that the politicians are operating with. And I feel like that is also important to point out. Don't get tricked by their arguments. They're operating on a very, very different level, and they don't have the best interest of their citizens or people at hand most of the time.
Well, that's a very good point, Andreas. Competition is great, but apparently not for governments when it comes to taxation. I don't know. Has Henrique arrived or?
He just also sent another email. He's still in the meeting, so
okay, maybe
we'll be flexible. But I have another point that I would like to add, and maybe we should discuss that. And that was in a recent discussion that we had with our friends from the European Economic Senate. One of the gentlemen mentioned that if the US is suddenly in favor of a minimum tax for enterprises in terms of 15%, it's actually only a business, or it's actually a policy that supports the US the US business location, insofar as there are places in the US, I just mentioned Delaware and others, where you have a much lower tax rate. And so obviously the new administration is just seeking new revenue streams. And in order just to avoid, that they will lose enterprises in the US, that they would go, for example, to Ireland, where they only pay 12.5%. They want the world to have all the same bad corporate location or business location, and that's why they want to have this tax of 15% in order to have negative competition for everyone. And I think that's also an argument that we should at least elaborate and look into. if that's correct or not. Andreas, you're the specialist from the US side. Would you agree on that, or is that not fair?
Well, I think it really depends on the individual circumstance of a company and where it's based, and you have to factor in so many other costs of moving costs, for example. Is this company able to find the employees that it needs? So I feel like it's very difficult to make that call. But what it is safe to say is that the U.S. administration right now is not so much concerned about the well-being and the progress of American companies. I mean, they in Pillar One, they basically allow many other countries to steal from the U.S. tax base. In Pillar Two, they're not so worried about competition anymore. And their focus is basically on how do we get the revenue that we need for our massive spending bills. And you see the same approach in the European Union when they tried to get the funds needed for their COVID relief and other budgets that they proposed. They were so desperate they even started a new trial against an American tech company, and they already said this is the fine that we need, and that we included in the budget already, and the trial hasn't even started, and the outcome is not clear. That's not the rule of law that we know, and that whenever governments operate and are desperate needs of funds for their budgets, the decisions that they made are probably only short-sighted and probably they're wrong. The one point I would like to make is the proposal from Biden started with 21%, and now we agreed on 15%. And important are two words that come before the 15, and that's at least. And so we will likely see an increase of that global tax rate in the next years. And again, once they have the foot in the door where they implemented the 15%, there's no guarantee that in the next couple of years they don't say now we want 21 or 25 or whatever number they might need to be implemented later on. And I feel like that is also the danger. If they were really for tax competition and they just wanted they want to stop the race to the bottom, how they call it, they could have picked 9%. That would have done no damage to Hungary, no damage to Ireland, no damage to anyone in the European Union and others that are negotiating there. But they didn't, because it's a European problem they're trying to fix. And so that's why they picked 15, because it changes things for Ireland and Hungary. And we should not agree to that.
I think there is one more point that we probably should include in the discussion, and I wrote it down from the G7 bill, and the G7 claims that the reform will help them to have more inclusive global economic prospects, which contradicts actually what they have said and what they say in the beginning. Then they will address climate change and stop the degradation of biodiversity, which seems extremely unlikely, because even if one believes that the stated objectives are indisputable and that the G7 governments make no mistake and are absolutely efficient, the corporate tax revenue raised would hardly suffice to fund any of those intentions. And since 1990, the revenue in G7 and all the OECD countries stays firmly below 3% of the GDP. So, making the argument to finance certain things with that is actually also something that one should question, to say it in a neutral way.
Very true. Maybe I should add that in Belgium, some tax experts have pointed out that Belgium will actually not gain from this, despite the fact that our corporate tax rate is here around is above 20%. And the reason is because Belgium is, let's say, host to big pharma. Most of the vaccines in this world are actually produced in Belgium, and there's Johnson and Johnson, there's GlaxoSmithKline, and these companies are based here because they can enjoy a special reduced tax regime for research and development. And also that tax regime is likely to come under fire from the United States if all these plans are being implemented. And indeed, with with the goal of the US to try to attract some of these businesses to US territory. Just to show that even if you're not Hungary and Ireland, but you have some specific tax regime for a specific innovative sector, which is the case not only in Belgium but in most, I think, European countries. You are threatened with losing industries. So it's a dangerous road ahead, and thank you very much for both of you to highlight to viewers. That's it. Can we welcome Mr. Schneider already, or is he probably not gonna make it?
Should we start with questions?
We could, I guess. The thing is, I cannot see them, so if any of you could basically read out the questions, that would be great.
I have a point here that it's the avoiding of taxation is an issue for one of our audience here.
Sure.
And I think I would throw it to you because Andreas, it's always the thing that, you know, with the tax havens where big multinationals, especially US companies, are based. Will this proposal avoid companies or avoid tax havens, or what? How do you see that? That's one question here.
So first of all, I wouldn't use tax havens. I would, call them countries that are more competitive than others, and it's they're financially sovereign and they can make those decisions. So I feel like tax havens is like a terminology of the left that it's designed to make us feel bad about competition, what I think is wrong. And I think the important point, and that's what people don't really understand, is that big multinational corporations, at the end of the day, they don't really care where they pay their taxes. If they pay it in the US or if they pay it in Europe, at the end of the day, they care about, do they pay more or less overall? And with certain restrictions in the European Union, let's assume that we implement also Pillar 1 and Pillar 2. And so the tax base changes for those companies. They will probably pay more in the European Union based on their user numbers, and then they will pay less in the United States. It's very unlikely that they will pay more overall. And so for them, the cost of business does not change. They probably have a little bit higher costs of complying with those new rules in the beginning. But at the end of the day, the real loser is or are the United States, because they lose significant parts of their tax base. And we can play this game from the other side as well. If we change those rules, there's countries like Germany and Belgium and France that will also lose significant parts of their tax base that they currently have under the current regime, because the rules will be different. And so it will be based on users in other countries as well. And so I think that's something that we have to think about. And I understand that there's a national interest in protecting the own tax base, but so far, no one is talking about that, because Secretary Yellen, for example, said those proposals will be revenue neutral. I don't understand how they can be revenue neutral if you pay more in other markets and not at home in the US, and have certain deductions that you can bring in because you paid more in other countries. So your US tax bill will be lower. And so it will not be revenue neutral for the US. And it's interesting that Secretary Yellen and many others are just misleading the public on those issues.
Peter?
Any other questions you think?
I have a question, and I have actually two questions here. One is, could you please repeat the link to the coalition letter that Andreas has presented? And I don't know, can you see the link, or otherwise I can read it afterwards?
It's in the chat, but
it's in the chat,
maybe we can post it on the Facebook page for the live stream. Otherwise, what you could do is you go to www.atr.org. And then you click on search and just type in coalition letter, and it's the first thing that will come up.
I can also repeat it. It's www.atr.org, taxpayer minus groups minus 40 minus countries minus urge minus rejection minus global minus minimum minus tax. And Victoria also said that she has already put it on Facebook. And there's another question. After the experience of FATCA, in which the US imposed its rules to banks all over the world, do you think the global minimum tax could be successfully applied? I think that question also goes to you, Andreas.
I don't know. I mean, I don't think that it will be successfully applied. It will take a very, very long time to implement it. It will take a very long time to agree on something. Even the European Union has not decided yet. There's going to be fierce opposition from member states that we just mentioned, like Ireland and Luxembourg and others. So I think it will take time. And then the question really is, will it be implemented if countries like China openly disagree with that proposal and say they will not join, or they will ask for certain exemptions that, you know, basically make this deal unworkable? And so I really don't know when it will be implemented or in what form. But I think that is an advantage for us to look at all the problems that this proposal would create and mention those and highlight those problems, because overall the entire proposal is not helpful for competition or for the West itself.
All right. Unless there are any other questions, I understand not.
There is one more.
One more. Then we go with one more.
Probably important for you as well, and you have been working on this field as well. So I will briefly switch roles. So I'm the moderator now, and you being spontaneous. But there is a question with regards to the digital taxation, and the question is whether, you know, we've seen kind of the same method of introducing a taxation into certain places or into the big agenda, putting on the big agenda. Do you can one avoid this G7 proposal, or is it definitely not going to be to go away? We've seen that with the digital taxation. Now finally they use it. So this is what was asked.
Well, if you
have a European perspective, Peter.
Should I comment? Yeah, sure. The digital taxation has been announced by many countries, but only very selectively applied so far, thankfully. What the United States are trying to do is also to say, oh, well, you have the global minimum tax rate now, so there's no more need to to go forward with that digital services tax. That said, the European Commission is still keen to push for it, but I think it may actually be hard for it to be implemented. If you're wondering what's the fate of this global minimum corporate tax rate, European countries were officially all applauding it, but in practice, it's not only going to be Hungary and Ireland that are going to resist it. It's I think also other small European countries like the Netherlands, for example, that will definitely try to obstruct this, try to drag it out, try to delay it, and I think I would not be surprised if ultimately they would manage to implement it, and they see that, as Andreas has pointed out, the likes of Russia and China are simply seeing this as a massive opportunity. I would not be surprised if then the United States itself basically U-turns on the matter and does not implement it. But people have not properly picked up that in Europe, many countries are quite dependent. Think of Luxembourg as well, for example, a small country, but it has a veto power at the EU level. That many European countries are actually, quite dependent on the ability to set their own taxes. Yes, I still want to see it happening, but of course, to be fair, it's a big step in the wrong direction, and it's important to create awareness about it and about the consequences for economic well-being.
And maybe I can add one sentence to that, what Peter said. I think a lot of countries also don't want to give Brussels more power at this time. I mean, the European Union really showed how ineffective and bad it can be at organizing extremely important things like getting the vaccines for the member states. I think that was a huge opportunity for the European Union, and they failed. And so a lot of countries say, why should we give more responsibility and power to Brussels? And why should we give away our fiscal sovereignty to bureaucrats in Brussels? And we should be in charge to decide at our level of government what is best for our citizens. And so I think this proposal really comes at the wrong time for some countries that are already struggling with this European superpower that they have to deal with in the past. So I think this all is a factor in the whole process. And if you look at the upcoming midterm elections in the US, depending on how long it will take for this proposal to be actually be able to vote it on in national parliaments, it might come at a time when we already had the midterms, and we have different majorities in the House and in the Senate, and so it might not even be possible to implement it in the US, and then this whole deal will fall apart, I guess, if the US is not participating.
Interesting. Maybe I should also add that indeed, sort of parallel to this initiative, at the EU level, the European Commission has for a very long time trying to agree joint EU taxation. I mean, it exists to a degree, like the VAT rates, the minimum VAT rates are set at the EU level. But the European Commission has been trying for more than 10 years now to harmonize the tax base, which is sort of the method according to which companies have to calculate what is taxable. So if you can sort of constrain countries in determining the rules for that, you can indirectly also affect taxation and trying to reduce tax competition. But the Commission has failed. Of course, after Brexit, the United Kingdom is no longer there to obstruct it. So you can see that there's massive pressure on, specifically on Ireland, to give in. And maybe a last development is, I think many people have noticed this, that at the EU level, there has been a decision to create an 800 billion euro recovery fund after COVID. So this involves the European Commission borrowing money on international markets. And of course, and then sending all the cash to member states to spend it, mostly not in a very optimal manner. But of course, these loans that the Commission is issuing at the moment will, of course, one day have to be repaid. And there's different options for that. Either the Commission sends an invoice to the member states, or what it actually wants and what has been agreed in principle by member states, but that does not mean in practice, is that you would have EU taxes, a plastic tax, the income of the CO2 emission rights, and there's some other possible routes to go to create EU taxes that would then be used to pay back the debt the EU has been engaging. Personally, I think it's because of the veto powers of member states and the unwillingness really to grant these powers to Brussels. It's unlikely that this will make a lot of headway. So in all likelihood, what they will do is to basically just take out a new loan to pay back for the old loan at the EU level, which is concerning in itself because, of course, it's also a power transfer to Brussels, to the central level, but it will not be as visible as actually transferring taxation power to the EU level. But we don't know. It's in at least 7 years, I think, when this will be really an issue. But yeah, it's a danger that through this strategy, the European Commission acquires taxation powers, and maybe they'll actually try to link it to this minimum corporate tax rate proposal. Maybe they say, oh, let's have a minimum EU corporate tax rate proposal as sort of a way to implement the international agreements more, but that's still a bit early to tell.
Peter, I would actually, if I may close,
Yes,
my closing remark would be the following.
sure.
We need to be looking at our bureaucracies and how efficient they are and how effective they are, in contrast to how efficient and effective our enterprises could be if they are less regulated. And I think that is also a point where we just simply can compare numbers and figures, and where answers are written down black on a white sheet of paper. And this should actually, this is reasonable, and this should tell us everything. The facts are on our side, on those who oppose high taxes, on those who oppose huge bureaucracies, and on those who oppose regulation, to the benefit of the individuals and of the people living in our countries. Thank you.
Thank you, Barbara. I think that was a very interesting contribution as well. Thank you, and thank you for your explanations before that, and thank you to Andreas as well. So I think we really covered the subject, and it will be possible to look at this again. Yes, that said, we look forward to any future meetings to discuss the issue, and let me wish you a lot of good luck and strength to continue to oppose these kinds of initiatives.
Thank you.